In my opinion, everybody must learn how to read balance sheets. There cannot be a founder, a managing director who can afford to say, I don't need to know how to read balance sheets and financial statements. In fact, not only the business owners, down the line, everybody must learn how to read balance sheets. But very often, what comes in the way is people think because I don't know how to make these statements, I will also not be able to understand how to read them. That's not true. Learning how to make and learning how to read are two different skill sets. But if that comes in the way, I always say, I will teach you how to make a balance sheet in a jiffy so that you no longer have an excuse because I don't know how to make, I will not learn how to read. A normal perception is it takes years to learn how to make balance sheets. But guys, I can give you a shortcut. Even if you don't know anything about accounting, you will be able to learn how to make a balance sheet. When I say balance sheet, guys, I use it loosely sometimes to mean both P&L and a balance sheet. So if you wish to learn how to make these statements without any knowledge of accounting, all you need to understand is a profit and loss account reveals expenses and incomes. A balance sheet shows liabilities and assets. And what do these statements between them reveal? They show everything that has happened in an organization over a certain period. Whatever happens in an organization from a finance perspective, every financial transaction that takes place, gets recorded in a set of books called accounts. And whatever gets recorded every once in a while, it gets summarized. And the summarized picture of accounts is presented in the form of two financial statements, a P&L and a balance sheet. And what do these two financial statements reveal between them? They show expenses and incomes and liabilities and assets. This will tell you that if everything that happened got recorded, whatever got recorded eventually has to appear here. And what appears on these statements are only four types of transactions. This will tell you, therefore, in an organization, nothing can happen which is not ultimately going to result either in an expense or an income or a liability or an asset. And I think this is all you need to understand if you wish to learn how to make a P&L and a balance sheet. Now you might say, Anil, just because I understand this, how can I make a balance sheet? My answer often is, I've said it in one of the earlier videos also, imagine from tomorrow you decide we will not write anything in books of accounts. Instead of that, what we'll do, we'll keep a little cardboard carton in one corner of the office. And every time a financial transaction takes place, instead of writing it in books of accounts, I suggest you write on a piece of paper and drop it into the box. And now at the end of a period, if I bring this box to you, this box might now contain God knows how many pieces of paper, thousands of pieces of paper. And I hand over the box to you and I say, can you prepare a profit loss and balance sheet? I think you can. How will you do it? Put your hand in the box, take out one piece of paper after another, read what is written on that. I am trying to tell you, you are going to discover whatever is written on that piece of paper will either be an expense. If yes, it goes to the P&L expenses side. If it is not an expense, it might be an income. Then you show it on the income side. If it is not an income, it might be a liability. And if it is neither of these three, you can blindly put it as an asset because there isn't a fifth option. Let's imagine our friend Carl over here sets up a furniture manufacturing enterprise. Let's visualize a few transactions and prepare a P&L balance sheet for him. Let's say he starts a business and calls it Carl Furnitures. Now, guys, what's the first step in a business? It needs money. Who needs money? Does Mr. Carl need money or does Carl Furnitures need money? KF, let's call it KF. Does KF need money? Answer is KF needs money. Where will KF get the money from? The first person it will go to is Mr. Carl. Carl, give us some money. Carl says, how much do you want? This business says, I want 10. Let's say 10 lakhs. Carl says, I'm not interested in giving you 10, but I don't mind giving you 4. What is 4 called now? 4 will be called Carl's capital contribution. But the business required 10. So for the remaining 6, they'll go to a bank or somebody. First obstacle has been overcome. This company wanted 10 lakhs, they got 10 lakhs. Now, what will they do with this money? They want to make furniture. So, a sizable proportion of money will go into purchasing the infrastructure to manufacture furniture. So, KF will now buy land and building and machinery, let's say worth 7 lakhs. Now that they have infrastructure, they will go and buy raw materials. They purchase raw materials worth 2 lakhs against cash payment, and they go to a vendor called Shreya and buy raw materials worth 2.5 lakhs from her and say, we'll pay you a month, 2 months later. So cash transaction has taken place, a credit transaction has taken place. Now that they got the raw materials and they have the machinery, they will now hire people, spend money on wages, spend money on overheads, spend money on various kinds of manufacturing expenses, another 0.5. Now the product is ready. So they go and sell it. They sell it for about 3 lakhs against cash. They sell to a customer called Shubham worth 4.5 lakhs. Who says I'll pay you a month, 2 months later? They've taken a loan from the bank. Banker says I want 10% interest. And guys, just to complete the set of transactions, they have purchased from Shreya and not paid her. So sooner or later they will pay her. And they have sold to Shubham, who has not paid them. Sooner or later, Shubham will pay them. Imagine this is the box that I spoke about. I bring this box to you and I say, guys, can you prepare a profit loss account and balance sheet? How will you do it? Keep 2 templates in front of you. One called profit loss account, second called balance sheet. A profit loss account having incomes on one side and expenses on the other side, balance sheet showing assets and liabilities on the 2 sides. Everything that happens in an organization has only 4 options. It will either be an expense or an income or a liability or an asset. Now, accountants have the tendency of putting a label against every transaction, and that label will read debit or credit. So guys, nature-wise, there are 4 options. From a debit credit point of view, there are only 2 options. So that tells you out of these 4, 2 must be debits and 2 must be credits. Now take my word for it, since I haven't explained how to reach this conclusion. Folks, expenses in the P&L are debits by nature, incomes are credits. In a balance sheet, liabilities are credits and assets are debits. And now, folks, look at each item after another. You can look at that item and choose whether it is an expense or an income or a liability or an asset. Let me remind you one more thing, which I had mentioned in one of the earlier videos. It is not only as simple as understanding there are 4 options that for anything that happens, but these 4 options can be subdivided into 2 groups. Because all transactions that take place in an organization can be broken up into those that bring money in and those that take money out. Guys, if money has come in, you don't have to choose out of 4. Money coming in will either be an income or a liability. And if money has gone out, it will either be an expense or an asset. So either you look at each item one by one and look at the item and choose out of 4, or you look at each item and first figure out, has this transaction brought money in or taken money out? If money has gone out, you got to choose between expense and asset. If money has come in, you got to choose between income and liability. But folks, you need to also understand one more aspect of accounting. Almost all over the world, we follow a system of accounting called double entry system of bookkeeping. What is double entry system of bookkeeping? It says for every transaction that takes place, it will have to be recorded twice. Why? Because each transaction that takes place will impact 2 account heads simultaneously. And incidentally, once it will appear on the debit side and again it will appear on the credit side. Guys, you don't need to understand what debit credit mean. All you need to understand is each transaction will impact 2 account heads, and once it will get recorded on the debits, again it will get recorded on the credit side. You don't have to do debit credit, it will happen. Let me illustrate. Let's imagine a transaction took place and you recorded 100 rupees on the expenses side. Where have you recorded it? Debit side. When will double entry be satisfied? When the same 100 appears also on the credit side. How many options do you have for that? Guys, in a P&L, expenses are debits and incomes are credits. In a balance sheet, liabilities are credits and assets are debits. You've recorded 100 on the expenses side, which is on the debit side. For double entry to be satisfied, the same 100 should now appear on the credit side. How many options do you have? It can either appear on the income side or it can appear on the liability side. Is there a third option? There is. Which is the third option? Guys, this 100 may also appear on the asset side, but then it should be a minus 100. What I'm trying to tell you folks is a negative figure on the debit side tantamounts to credit. A negative on the credit side is equivalent to debit. So folks, you got to look at each transaction, identify the two account heads affected, logically record them. Don't worry about debit credit. Having recorded, double check. If you find you recorded a positive 100 on the expenses side and this positive 100 is accompanied by either a positive 100 on the income side or a positive 100 on the liability side or a negative 100 on the asset side or a negative 100 on the expenses side itself, double entry has happened correctly. And guys, this will happen on its own. You don't need to do it. Let's watch it. Now imagine this is the box that I bring to you. You put your hand in the box. The first piece of paper that comes out says capital. I said you can either choose out of 4 or you can apply your mind and figure out has money come in or has money gone out. Guys, Carl introduced capital, so money has come in. If money comes in, your options are it will either be an income or a liability. This is certainly not income because Carl Furnitures has not earned this money. So by default, it must be a liability. So let's put capital on the liability side. But folks, this is single entry. Double entry says examine the same transaction and you'll discover another dimension. So tell me, what is the second effect of this transaction? In what form did Carl bring this capital? He must have brought it in cash. And where is this cash today? Carl Furnitures right now is in possession of 400,000 cash. So it's an asset. Guys, did you notice while recording, I didn't even bother about debit and credit. I simply applied good logic. But because my logic was sound, this item has appeared once on the debit side and again on the credit side. Debit, credit, I won't have to do. It'll happen. Next piece of paper that comes out of the box says loan. Again, money has come in. Again, the choice is income or liability. This is also a liability. And what about the double entry? Now the cash available with Carl Furnitures has become 10 lakhs. Next item says they purchased land building machine. This time money has gone out. Choice is either an expense or an asset. Land building machine look like assets. Single entry. What about double entry? In case you are saying this should be shown as an expense, I must remind you that money going out is either an expense or an asset. You already chosen the asset option. It cannot be an expense. And if you record it as an expense, when you double check, you'll find it is appearing twice on the debit side. That's a hint you're making a mistake. So what is the double entry of this? Folks, they no longer have 10 lakhs with them. They spend 7 on building. So cash goes down to 3. How did you record a debit? You recorded a debit when you showed 7 lakhs on the asset side. How did you record a credit? When you deducted 7 lakhs on the asset side. There's a positive figure on the asset side playing the role of debit. There's a negative figure on the asset side playing the role of credit. But it's happening on its own. We're not doing it. Next item says they have purchased raw materials. Raw materials going out seems to be an expense. And we are assuming they're all consumed. What about the double entry? When you purchased raw material worth 2 lakhs, your money went out. So the cash of 3 now becomes 1. Then they bought raw material from Shreya. Guys, buying raw material is an expense. Whether you paid or not, that's part of the double entry. Yesterday you bought 2 lakhs worth of raw material, it was shown as an expense. Today you purchased 2.5 lakhs worth of raw material. So raw material on the expenses side of P&L becomes 4.5 lakhs. But you did not pay Shreya. So cash doesn't go down. So Shreya then becomes a liability, payable. In English, she'll be called KF's creditor. Why is she called a creditor? Because the number appears on the credit side. Then you spend money on manufacturing expenses. Manufacturing expense is an expense and takes away money. So cash of 1 becomes 0.5. And then when you sell goods worth 3 lakhs on cash, it is income. And this income brings money. So your cash of 0.5 becomes 3.5. And then when you sold to Shubham, guys, sales is income. You sold 3 lakhs yesterday, you sold 4.5 lakhs today. So your total sales on the income side becomes 7.5, but Shubham did not pay. So no impact on cash. So Shubham becomes an asset, receivable, called a debtor. Then when you pay interest to the bank, it is an expense. And this expense takes away money. So 3.5 becomes 2.9. Next item is you have paid Shreya 2.25. Where does it appear? In case you say it is an expense, I must remind you, it was an expense the day you purchased from Shreya. You can't show the same item as expense when you buy, and again you show it as an expense when you pay. Guys, remember, balance sheet is a statement of assets and liabilities as on a particular date. On the date of balance sheet, how much money do you owe Shreya? You purchased 2.5, you have paid her 2.25, now you owe her only 0.25. And when you pay her 2.25, your cash goes down from 2.9 to 0.65. And when Shubham pays you 4, your cash of 0.65 becomes 4.65, and now Shubham owes you that much less. So 4.5 minus 4, the amount he owes you on the date of balance sheet is 0.5. That's it. Now let's find out, has this organization made a profit or loss? To do that, let's find out the total of both the sides of P&L. What is the total of the expenses side? It is 5.6. What is the total of the income side? 7.5. Write the heavier side figure on both the sides. And since the income is greater than expense, this organization has made a profit. They have made a profit of 1.9. This figure must now get transferred to the balance sheet. Where will profit appear in the balance sheet? Is it a liability or is it an asset? Folks, profit is a liability. Why is it a liability? That I'll tell you another day in another video. But right now, all I want to tell you is, in a P&L account, the income was greater than expense. The credit side of the P&L was heavier than the debit side. So profit represents a net credit. And a credit balance in the P&L can only appear on the credit side of balance sheet, which is the liability side. The common sense answer I'll give you some other day. So profit appears as a liability. And why is a balance sheet called a balance sheet? It's not called a balance sheet because the two sides balance. Incidentally, they do balance, but the word balance in a balance sheet has got nothing to do with a weighing scale kind of a balance. But does this balance sheet balance? Of course it balances. Folks, I want you to observe, we have just now prepared a balanced balance sheet with the help of that 2-minute input that I gave you. That everything that happens will either be an expense or an income or a liability or an asset. And each transaction that takes place will be recorded 2 times.